webinar now, the second this year on AI frontiers in finance. Just again, as a quick note, the webinar is going to be recorded. As usual, you will find everything in a couple of days, both on YouTube, the video, and then more information on our website, the slides also, if you wanna revisit them. Let me briefly go through a few polls. So as usual, the webinar AI Frontiers, we host this here at the Center for European Transformation, and it's been organized or set up by Birgit Frankenberg, who's also here, who founded a High Peak, a management consultants company here in Frankfurt, and Paulina Verhoff, who's a PhD student here. She cannot be here, unfortunately, today because she's basically traveling back from a seminar that she gave yesterday, and myself. And the idea of that webinar was to basically bring people together, bring on the one hand academics and also industry participants, because these AI topics, everybody is sort of working on them, but there's a lot to learn from each other in terms of what are interesting use cases, what are interesting modeling technologies, so to speak, for these use cases. So we've learned over the last 5 webinars, at least, there's a lot of interaction and a lot of things that's really interesting. And so I'm really looking forward to learning more from this webinar as well today. As usual, you should get involved as well. So here are 2 ways and you can do that. You can use the email aifrontiers@fs.de, specifically if you have questions regarding technical stuff that doesn't go the right way. But if you have questions for our panelists, then please use the Q&A button. You can type in your questions there. If you have the similar questions, you can just vote them up, that we see that you specifically like them. And then all of us can see them, both Oliver as well as Robert can then basically pick them up, or we do that eventually in the discussion along the way. So please do that. And today we're going to talk about specifically deep learning for corporate bonds. So if you remember, if you've been here with us, and specifically in the first 2 webinars that we already had talks about deep learning when it comes to asset prices, but at this point we talk more about equity returns, how we can forecast equity returns using also deep learning methodologies, and also sort of what might be actual limitations to those models, specifically because we kind of train them at hindsight with more information than actually investors had when they make the investment decision. So that was pretty interesting. And today we're going to do a deeper dive into the world of corporate bonds. So we are very happy to have very true, knowledgeable people in this area. On the one hand, Oliver Giesecke, who is also German. We just talked about this in the sort of pre-briefing, so to speak. He got his bachelor here in actually at Goethe here in Frankfurt, and then moved to the US, and eventually got his master in philosophy and then eventually PhD in finance and economics at Columbia University, and has been now for more than 3 years at Stanford University Hoover Institute. And he's going to present some work that he did recently on deep learning for corporate bonds. And then we have from the industry, we have Robbert-Jan who is from the Netherlands, and joins us from Rotterdam, I believe, who has a bachelor and a master in science from Erasmus University, and has been now with Rabobank for more than 7 years. And as I see, also specifically works in a quantitative field related of also dealing with corporate bonds and asset pricing models here as well. But I think they will more introduce them also themselves. So before we actually enter into our webinar, I would briefly like to do a poll every time, just to get you guys engaged. And I have a very small thing prepared. So we leave it open for a couple of seconds. So the question here is, so today's webinar explores the application of AI in pricing corporate bonds. What do you think is the biggest advantage of using deep learning techniques in bond investing? Higher returns and better performance, improved risk management and lower volatility, enhanced ability to predict market downturns, or more efficient processing of large data sets? So I'll give you a couple of seconds, and then we can start and ask our panelists how they think and whether they expected this response as well. A few more seconds. 75% responded. And let's close it here. Let's look at the results. So I think everybody can see them. 55% more efficient processing, 30% improved risk management, lower VOLA, and then higher returns as well as enhanced ability to predict. So now bringing this over to you both, Oliver and Robert, is this something you would have expected asking the audience about this?
Yeah, that's very interesting. I did not expect these answers, but I can clearly see the applications of AI in these areas. Hopefully, I can convince you after the talk that you can also do a little bit better on the first answer, which is higher returns and better portfolio performance.
Robert, what do you think?
Yeah, and yeah, I think actually I do agree with the processing of the larger data sets, because maybe traditional methods have more problems dealing with those large data sets, and then machine learning and even deep learning can really help to extract all the information from the data. So I think I agree there. And then yeah, the higher returns, lower volatility, or better predictability of market downturns is something that you want to get out, of course. Although I've also seen examples where the opposite happens. So it's not a certainty, unfortunately.
All right, this appears to become a very interesting discussion among you both. So let's stop this right here. I'm going to mute myself and hand over the floor to Oliver. Oliver, Robert, thank you so much for being here. We really much look forward to what you guys have to say. Thank you.
First of all, thank you so much for having me here at the webinar and for the kind introduction. As you said, yeah, I did my undergraduate at Goethe University, and so I lived almost like 7 years in Frankfurt before I moved to the United States. Today, I'm going to present work with Yetli Duray, who actually studied in Munich for a long while before he moved to the United States. And the title of the talk is Deep Learning for Corporate Bonds. So before I jump into the paper in more detail, let me just give you a sort of a high-level motivation and a high-level description of what we're doing in the paper. So the main goal is asset pricing for US corporate bonds. So US corporate bonds are a large asset class. According to SIFMER, there's about 11.2 trillion US dollars in US corporate bonds outstanding. So there's approximately half of the US Treasury market. So unlike in the equity market, in the bond market, there's no sort of conventional data set available. And so one of our contributions is to assemble a unique data set that both contains bond returns, macroeconomic fundamentals, individual bond characteristics, as well as the issuer fundamentals, as well as equity returns. And then really the goal here in the paper is to estimate a stochastic discount factor in the space of tradable assets via machine learning. So one of the sort of challenges here is that we're dealing with a very large amount of conditioning information. So we have like 240 time series alone, but if you want to include all the interactions, you end up with a very, very large data set. So one of the challenges here is to find a sort of efficient way to reduce the dimensionality. Another thing that we want to allow for is a more sort of flexible functional form of the stochastic discount factor, specifically deviating from a more like sort of traditional linear specification. And so interestingly, from a theoretical perspective, there are two ways to estimate the stochastic discount factor. I'm going to show you that in a lot more detail, minimizing the mispricing loss, and second, a direct maximization of the Sharpe ratio. And so there are some interesting, I think, results that are coming out from bringing these two approaches to the data and see the empirical results for that. So ultimately, we are estimating stochastic discount factors for both at the bond portfolio level, so following more sort of the equity asset pricing literature in the past, as well as on the individual bond level, which really makes like takes full advantage of all the micro data. So with that, let me just briefly summarize some of the main results. On the bond portfolio level, we find annual out of sample Sharpe ratios between 0.76 and 0.87. It turns out once we incorporate macroeconomic time series, we get actually higher Sharpe ratios and lower maximum drawdown. So it seems like we can predict some of the business cycle frequency variation. And what we also find is that the stochastic discount factor portfolio shows statistically significant excess returns with respect to S&P 500 and Pharma Friends 3 and 5 factor models. So we're using the risk factors from the equity literature because there's still like a little bit of a debate what are the right risk factors in the bond market. And so we want to just be, transparent about that. At the individual bond return level, we find annual out of sample Sharpe ratios between 0.41 and 1.0. Here we find actually much higher annual excess returns of about 12% vis-a-vis the S&P 500 and about 12% against a Pharma French 5-factor model. So, I think a pretty significant returns here. Also, and that's a little bit different from the bond portfolio level, since we have a lot more variation, we find that the mispricing loss actually provides higher cross-sectional and time series predictability. However, if you look at the characteristics of the stochastic discount factor portfolio, we find higher Sharpe ratios as well as better portfolio performance when we use the Sharpe ratio maximization. So just to broadly connect that with the literature, and I keep that relatively short in the interest of time, but we're connecting to some of the asset pricing literature in the fixed income space, so that has traditionally been in the treasury securities. For treasury securities, we also connect to sort of the nascent literature on asset pricing for corporate bonds, and we draw on some of their data. And as Sasha mentioned in the introduction, there's been more and more interest to bring a machine learning to asset pricing, but that has traditionally been more sort of on the equity side. And so we are bringing some of those methods to the US corporate bond space. So with that, let me just briefly introduce our data and our sample, because this is something that is sort of not available off the shelf. There's no such thing like CRISP, where you can basically read, bond returns of a big data set. So we had to do a fair amount of work here. So the bond returns, really, we are building a lot on the work by Yoshihiro Nozawa and Alkami, as mentioned here in this data set, which draws on 4 main data sets. That's the Lehman Brothers fixed income database, Merchant, FIST, Trace, and DataStream. We also built on a similar portfolio definition as the Alkami paper. That means we are constructing bond portfolios based on credit spreads, intermediate capital exposure, credit rating, etc. We then augment the return data with macroeconomic time series using the FredMD database, which is essentially monthly time series of macroeconomic variables from McRacken and Ng, and have some additional variables from Welch and Goyal. Another big challenge here in this data set is that we had to match individual bond CUSIPs to their ultimate issuer, so in order to bring in the issuer fundamentals. And so we essentially had to build a crosswalk between the CUSIPs as well as the corresponding identifier in Compustat. And so here we're drawing on several data sets, including Merchant FIST, S&P rating file, Capital IQ, as well as iterative name matching to basically build this crosswalk. once we had these crosswalk, we could then augment it with Asia fundamentals and equity characteristics that come mostly from CompuStat, and that includes all of those things like total asset, cash position, cash flow information, profitability indicator. So it's a set of approximately 45 additional issuer characteristics. And then obviously we could also compute market-based characteristics like risk exposures, shares outstanding, market to book ratios. Okay, so now since I explained how we got the data, let me also show you what type of methodology we are employing. And as I mentioned in the introduction already, we're using two main estimation approaches to estimate the stochastic discount factor in the space of tradable assets. I'm going to show you the approaches in a little bit more detail, but let me just briefly outline what the two approaches are. So in the first approach, we're using a minimization of the mispricing loss. That is, we're using the definition of the stochastic discount factor, which we can translate in a conditional moment restriction, and then essentially deviate all the deviations from that moment condition as the objective function. In the second approach, we are maximizing the Sharpe ratio of the stochastic discount factor portfolio directly. This uses essentially the property that the projected stochastic discount factor in the space of traded assets is the one that has the highest Sharpe ratio. And so as a result, we're using that as our objective function. And so I should say that it's quite interesting because theoretically, these two approaches should yield the same results. But however, once you bring these two approaches to the data, you find some differences, which I think are quite interesting to explore. So with that, let me just be a little bit more precise on the first approach. As I mentioned, the no arbitrage condition implies a conditional moment restriction of the following form, that the expectations with respect to the time t information set of the stochastic discount factor times the excess returns equals 0. And so we use this moment condition and substitute in linear stochastic discount factor, at least in the span of tradable assets, as you see here in this line, into the stochastic discount factor to end up with the following expression N2, which is essentially the deviation from the stochastic discount factor, or the deviation from the conditional moment restriction across all the assets. I should mention that this linear discount factor is without loss of generality, because this omega function could be a non-linear function, and as a result, it actually generalizes. I should also mention that this omega really here, that is basically the portfolio allocation in the tradable asset space, is the one that minimizes the mispricing loss, but it also gives you essentially a portfolio allocation that yields a tradable portfolio strategy. So you know basically what are the conditioning information and time t, and based on that, these functions will give you an allocation of what you should put into the portfolio for the next period. The second approach, as I mentioned, is maximizing the Sharpe ratio of the stochastic discount factor based on the property that that the SDF should exhibit the largest Sharpe ratio. It turns out that the fractional definition of the Sharpe ratio is somewhat problematic, and so instead we're using a linear version of the Sharpe ratio during training. This linear version essentially balances the first and the second moment of the return distribution, and this is shown here in equation 3, where the gamma really here is sort of the penalization for for the standard deviation, and it can be interpreted as a risk aversion parameter that essentially controls the relative importance between mean and standard deviation. it is also can be taken as a hyperparameter during training to essentially achieve the best performance in the validation set. So with that, I want to now come to the results. I want to present the results at two levels. First, I want to show you what we obtain at the bond portfolio level, where we obviously have a lot less information because we can't use individual firm characteristics. We can't use individual bond characteristics, but we want to be as close as possible to sort of the traditional equity literature to show what results we would get there. And then in the second part, I'm going to show you the results at the individual bond level, where we use like the full granularity of the microdata. So with that, let me just show you the results. So here, just to explain the first table, we have the different objective function. MP stands for mispricing loss, SR for Sharpe ratio, and then the data environment, where we experiment with only the bond portfolios plus the macro data. And then we have a set of characteristics or metrics that basically represent the out of sample performance. So the best model here achieves a monthly Sharpe ratio of 0.25. So this is the first line, which translates to a Sharpe ratio of 0.87 annually. Interestingly, here in this setup where we have much less data, the differences between the Sharpe ratio maximization and the mispricing loss are generally small. So you see like only like a drop of 0.01 here in Sharpe ratio in the more extensive data environment, versus basically no difference here in the slightly less rich environment. Also, it turns out that actually the macroeconomic variables really matter in these environments. So you see, for instance, that the maximum drawdown is like much bigger once you exclude the macroeconomic characteristics. Also, generally, there are better Sortino ratios, and you will see, if we get less significant excess returns once we exclude the macroeconomic characteristics. So I mentioned excess returns. So these basically tries to evaluate the performance of the stochastic discount factor portfolio that the model implies relative to commonly used risk metrics or risk factors in the equity market. Once again, we use the risk factors in the equity market mostly because there's not yet a convention what the right risk factors in the bond market should be. So here in the bond portfolio setting, we get risk excess returns that are relatively small. So we get, for instance, here in the preferred model, we get excess returns at the monthly level of roughly 0.1%. This translates to an annual excess return of 1.2%. They are significant with respect to the S&P 500 as well as the Pharma French 3-factor model, and marginally significant with respect to the Pharma French 5-factor model. I should mention, once we exclude the macroeconomic characteristics, I think while the excess returns are slightly higher, we get the returns generally a little bit more noisy, and as a result, they are statistically weaker. Okay, so now I want to show you the individual bond level results. Here we have, once again, a similar table that summarizes the results. So in the objective, once again, MP stands for mispricing loss, SR for Sharpe ratio. And then in the environment, we have essentially individual bond characteristics, issuer fundamentals, as well as macroeconomic characteristics in the first two lines. We exclude macroeconomic characteristics in line 3 and 4. And then basically line 5 and 6 are robustness check that excludes financials as well as REITs from the sample. So in this setting, we find that the best performing model on the individual bond level achieves a monthly Sharpe ratio of 0.29 which translates into an annual Sharpe ratio of roughly 1. I think here we find that, interestingly, the Sharpe ratio maximization performs overall better than minimizing the mispricing loss, both in Sharpe as well as Kalmar ratio, and actually the differences are quite significant here. Generally, we also find that Sharpe ratio maximization leads overall to higher annual returns. I will show you a plot on the next slide, which really shows their substantial differences. Interestingly, I should say that here in these contexts, it seems like the macroeconomic characteristics seem less important. I suppose this is mostly because we have a lot of individual, issuer level fundamentals, which are highly correlated and more predictive at the individual bond level than at the portfolio level. I should also mention that all of these results are pretty robust to the exclusion of financials as well as REITs. So I mentioned already that the two different objective functions can yield very different returns, especially mean returns. So you find that here, this is basically a plot of our out of sample test set, where we find that very different annual returns using the mispricing loss, which is shown in by the blue line, versus the Sharpe ratio maximization as indicated by the orange line. You find like the mean returns are quite different. However, the Sharpe ratio maximization does seem to have higher drawdowns as well as more volatility overall. So in terms of excess returns, we actually get like excess returns which are pretty big. So in our preferred specification, which is the fourth line here, we have monthly excess returns of about 1%, which translates to an excess return of 12% annually. And this is highly statistically significant vis-a-vis the S&P, as well as the Farmers Ranch 3-factor and Farmers Ranch 5-factor model. So I think interestingly, even the size gets only mildly attenuated and maintains a high statistical significance. I mentioned already the contrast between the two objective function. I would say that while the first results always sort of indicated as shown, for instance, here in the Sharpe ratio, that the Sharpe ratio maximization always yields better results. This is actually not true under different evaluation metrics. So here in this table, I show you the explained variation as well as the cross-natural R-squared. And it turns out that once you use the mispricing loss, you generally find that these yields much higher explained variation as well as a cross-sectional R-square. So in other words, it seems like that using the mispricing loss actually yields more predictability. However, it yields lower or worse portfolio performance out of sample for the stochastic discount factor portfolio. And so, our takeaway, it seems to be that the mispricing loss is really better when you try to explain all the variation, and you have a lot of idiosyncratic variation as here in the individual bond return level, versus, prior we had seen that in the bond portfolio results that there's very little variation and very little differences, and I think we think that as a result of that there's just less variation in the data. I should say that intuitively it makes sense, because the Sharpe ratio maximization, when you use that as an objective function, this is much closer aligned to if your ultimate objective is to achieve a portfolio with great performance. Portfolio performance according to like the conventional indicators. So with that, let me just briefly conclude and summarize what we did in the paper. So we built on the advances in data availability in the corporate bond space and the machine learning literature in the equity space to estimate an asset pricing model for the US corporate bond market. We had used like two approaches. First, the minimization of the mispricing loss, and second, the maximization of the linear Sharpe ratio. While they theoretically should yield similar results, we actually get that Sharpe ratio maximization generally yields better out of sample portfolio performance and excess returns, while the mispricing loss yields higher predictive performance when we have a sample with large idiosyncratic variation. Also, I should mention, and due to the time constraints, I haven't shown you these results in more detail, but that we get much better results with nonlinear models that generally show smaller pricing errors, higher Sharpe ratios, and more variance explainability. Let me stop here.
Perfect. Many thanks, Oliver, for the introduction and the presentation here. Robert, over to you. I think you also have some slides you prepared.
I didn't have slides, but I did have some notes, definitely. So thanks a lot. And first of all, I want to thank the organizers for having me and for having this nice and very relevant, I think, webinar series. And also thank Oliver for the great presentation. I've actually some highlights or some points that I want to highlight from the paper that maybe Oliver already touched upon, but I want to zoom in a bit more on, and then later also reflect on a couple of points from really a practitioner standpoint. So first of all, the thing I wanted to mention is that the authors really did a great job in terms of the data, creating the data set and working on the methodology. I think the presentation doesn't really do it justice how much effort there needs to be put in to get this corporate bond data cleaned and collected, and same for setting up the methodology. So first thing I wanted to mention is a bit more general comment. It's about really bridging the gap between the equity and the corporate bond literature. So what we've seen is that in the equity literature, there's a lot of papers being published on a continuous basis, which makes a lot of sense because the stock market is huge and very important for our economy. However, the same argument holds for the corporate bond market, as it's also huge and arguably as important for the functioning of our economy. However, the academic literature is much smaller. So if you think about this, what are the reasons? Why is this much smaller? So there's a couple of reasons I can come up with. So one is maybe familiarity. So maybe in university, if you get finance courses or other courses, the main content is about the equity market. But also, if you do your own trading, it's mainly, I suppose, on the stock market or equity ETFs compared to buying individual corporate bonds. At least I haven't bought one myself yet. Actually, I didn't even know that much about corporate bonds before I started working as a quant researcher in a quant credit team. Of course, over the last 7 years, I've got a lot of experience with this, but I even didn't have this experience before. Then the second point is complexity. Things like bond price, duration, how do you calculate them? For some people, it is a quite complex topic. And finally, I think probably the most important is the difficulty of acquiring the data. So as you saw described by Oliver, he had to collect 4 different data sets, combine them, do a lot of mappings, etc., to even get some research out on this corporate bond data. And here I wanted to point actually to the more practitioner side of the academic literature, because maybe in the more academic literature, there's not a lot of papers on corporate bonds, but on the more empirical asset pricing, there are quite some practitioner papers in journals like FHA, Journal of Portfolio Management, and Journal of Fixed Income. And here companies like AQR, BlackRock, but also Robeco publish regularly on topics also on corporate bonds. So I don't know if Oliver or the audience looks at those journals, but they could be also very interesting to gain insights into this bit more obscure market. But I would say that makes it also more interesting as an academic, because there's a lot of possibilities still to contribute, and for a practitioner to harvest inefficiencies in the market. So that's one more general point. And then a second point I wanted to highlight, I think really not given a lot of attention generally, is having those multiple loss functions in the model. So this has to do with the methodology. So here both a mispricing loss minimization and a max Sharpe ratio objective are compared, and those are theoretically the same, but then in practice it is found that they don't give necessarily the same results. I think this is also a very important finding again, because it shows that when working actually with the data, results can be different from maybe the theory or your expectations. So it's also important to really work with the data. But next to that, I also want to point out that most papers that I read, I see that they focus on the feature engineering. So coming up with all kinds of features to feed into their machine learning or deep learning model. But this is an example of target engineering. So here you try to change or tailor the objective, which I think is as important as feature engineering. One other example of target engineering could be if you're interested in longer horizon returns. It could be useful to predict maybe 1 year ahead returns instead of 1 month ahead returns for your model, to make it slower and pick up on those more slower effects. And I actually had also one question to Oliver here. So you use two methods that are theoretically equivalent. Have you thought about maybe averaging the outcomes of the two to do some sort of model averaging?
Yeah, great. I mean, these are a lot of points. So let me just try to touch upon a few of them. So in terms of data, I think you made a very important point that, in the bond space, there's just no data set available that, people agree on that you can download off the shelf. In the equity market, you go to CRISP, at least in the United States, you get basically every return going back to 1930s. You have even like a crosswalk between CRISP and CompuStat, so you can basically merge in the A-share fundamentals. Whereas in the corporate bond space, there's no such thing. I mean, in fact, like corporate bond returns are only systematically recorded, like very systematically recorded since 2003, when we started to have TRACE, which is essentially a trade repository, right? Before, there are like quotes from investment banks and so on. So in order to get a decent sample or the longest sample possible, you have to rely on those. But really, like, similar reliable transaction prices like in the equity markets are only available since 2003. I totally agree. I think it's like kind of a gold mine, just because, like, it's still like a relatively underexplored area in the literature, and so it was really interesting to work on those things, and be sort of the first on putting out a combined data set and thinking a little bit more carefully about how you want to approach that. I guess, like, so maybe we just want to foreshadow actually some work that is currently in progress. So we're actually trying to combine both like the bond pricing and the equity pricing in one asset pricing model, because like the theory at least tells you that there's one stochastic discount factor out there that is supposed to price all the assets in the economy, right? And so So we're trying to see to what extent there are maybe complementarities from basically estimating both asset and bond prices simultaneously, or to what extent there might be trade-offs, right? In terms of, maybe there's you get like worse performance in both markets, but we will see how that pans out. In terms of like feature engineering, I think that's an interesting point. Actually, in this paper, we take the approach, let's just take all the features that the literature has pointed out that might be helpful to predict asset pricing returns, and just try to find essentially like the biggest set of features, and we try to be as standard as possible. And then in terms of an objective function, I think that's like, I think academics really like to work with like stochastic discount factors and taking sort of the initial moment condition as the objective function. But it turns out that, as we have seen empirically, that is like challenging in an environment where you have a lot of variation. And so using like, the portfolio objective, which is essentially like the Sharpe ratio, if that is your point of the view, actually, gets some gains. And so I think there's also related to some of the questions that we got here in the Q&A. There's sort of the risk maximization, like the risk aversion parameter affect the results in a meaningful way. And so ultimately here, I'm not sure whether we actually tabulated the results, but we're using the risk parameter in the Sharpe ratio definition essentially as a hyperparameter. So we're splitting our data into three sets, and obviously, given that we're working with returns, we had to do it in a chronological way. We have the initial training set, we train different models, then we evaluate those models, which have different hyperparameters and model architectures in the validation set, and then we are basically picking the best model in the validation set to take it purely out of sample and see what the model performance is, which I reported in those tables. And so we had a set of values for the risk aversion coefficient that we essentially put in to the initial set of models that we estimate in the training data set, and then we picked basically the risk aversion parameters that gave the best performance in the validation set. But yeah, it would be interesting to explore that a little bit more in detail, to basically fix the model architecture and the other hyperparameters and just play around with the risk aversion and see what are the trade-offs here.
Yeah, I was actually also interested in this question, so thanks, Frederik, for asking. And something else that I wanted to point out that you haven't even mentioned in the presentation is that the code is actually shared online, or much of the code. So I think there's not many papers, especially in finance, that do this yet. So that's really great, and allowed me to have a look at like how the models were implemented and see. Learn basically better what's happening, because all the maths and of course the explanation in the paper helps, but then seeing the actual code gives you, I think, the best clarity, and also allows the audience or practitioners like me to replicate or results, if of course the data is available. So I think that's great, and more people should do it.
Let me just follow up on this point. I think one of the takeaways on the project is that, there's a lot of work to be done on the methodology side, on the data cleaning side, but I would say there's just as much work to be done in the sort of engineering side. That means like in the model implementation. So for instance, and I actually didn't touch upon that question, you asked, is there maybe a possibility to combine different models, right? So I should say, for instance, that all the results that we get are ensemble results. We're basically running like the same model, but with different random states at the beginning, because each model is basically depends on some initialization. And we have like, I believe 5 models where we make essential predictions, and then we averaging the predictions within a class of model to basically see what the portfolio allocation should be in the next period. And so, this ensembling usually works pretty well. Actually, we haven't really explored the ensembling between a model that we estimated with like Sharpe ratio maximization versus and mispricing loss. And I really can't make a prediction in which direction it would go, right? Because like it seems like that those mispricing loss models are generally have much lower Sharpe ratios. I think like if you were to model average them, you would probably end up with a slightly worse performance, but that's just a guess. Ultimately, all of those results are becoming sort of a more like an empirical question, right?
Yeah, I would expect that like the predictability will be in the middle, but also the performance will be in the middle. So you could say that it's maybe more balanced. So maybe for running such a model in practice, it's safer because it works well on most metrics.
Can I maybe I have a question basically. Maybe given that we have both of you here, maybe you can both answer. So Oliver, you mentioned in the presentation at some point when you looked at sort of the excess returns that you could estimate based on these models. And then we're saying, okay, well, you went to the stock market to do that because there are sort of like known risk factors. So I'm not really in that literature, but we have done some work recently on estimating. We wanted to see trading behavior in the secondary corporate loan market actually after covenant violations, and here we actually try to get also at excess returns in the loan market and looked a little bit into this literature, and it appears to be at least there seems to be some papers that use general returns from like T-bills, investment grade bonds, high yield bonds, and maybe even the S&P 500s to generate some sort of benchmark. Isn't this something that would be possible also in the field that you're working at, or why doesn't it get maybe good results that might be interesting for you?
Yeah, that's a good question. I mean, first of all, I should mention that all the portfolio returns are already excess returns with respect to like a short-term treasury yield. But then the question is more like, is basically the return that we get only like beta driven? So does it load like heavily on like known risk factor, or do we actually generate some additional excess return in this case alphas, right? And so that's really sort of the spirit of that exercise, where we basically try to see, okay, how much of these return that we're seeing in these portfolios is
I think Oliver is frozen for the moment, or?
Yeah, I think he dropped out, or he's frozen. Yeah.
no, that does it make sense?
Oliver, you were back for a few seconds. You went off for a few seconds. We didn't.
Okay, so I'm not sure where I was cut off, but basically the spirit of the exercise is to see what fraction of the return is driven by systematic risk factors as identified in the equity market, and what if these returns are basically alpha. That means like excess returns, which is not explained by any other systematic risk factor. And we find that, a significant share of the return is in fact alpha instead of beta.
Yeah, if I also can comment on that, I think it's a very relevant question, like what benchmark to take. And for example, in our own corporate bond strategies, we are benchmarked versus corporate bond indices. We generally take those then as the benchmark. Those are market value weighted, like the Bloomberg corporate bond index, US corporate bond index. And I think this is also generally done in those more practitioner-based papers where they take just the bond market as the as the benchmark, and then indeed look for alpha versus the bond market. So you could see it as a bond cap N, and there's actually plenty of papers that I think use this methodology. So I think that would be interesting to do. One thing actually I want to note for the audience as well is that you could even argue that the bond market portfolio is not a fair benchmark, because the bond market is well known to have lower liquidity than, for example, the stock market. And the bond market assumes that it has market value weighted all the bonds. But acquiring all these bonds is very difficult in practice. And the bond market, in comparison to the equity market, has very high turnover by construction, because new bonds are issued all the time, bonds mature all the time, they can get called, companies can default, of course, in high yield, and bonds can even drop out of investment grade into the high yield index. So there's a lot of ways that there can be turnover. For example, in the IG index, I think it's more than 40 to 50% turnover per year just from the index, if you try to track it. So there's even some research saying you should compare it to investment performance of mutual funds or ETFs. But I think for a paper, taking just the market value weighted bond market is probably a good approach. And actually, something else I wanted to touch upon is the SDF. So here, of course, the SDF is the assumed like superior portfolio on the tradable assets. But doesn't this ignore all market frictions that are present in the corporate bond market, like short selling constraints, liquidity constraints, which make it hard to have high turnover, shorting bonds, and maybe also taking leverage. So how do you see this? Should we maybe differentiate between like the ultimate SDF without market frictions and then an implementable SDF where we add back some of those market frictions?
Yeah, that's a good point. So I think, like, let me, for instance, touch upon leverage. So if you actually estimate an unconstrained model, you would get very, very high implied leverage. And so as a result, we found, I think, a pretty neat way to essentially put leverage as a fixed constraint into our optimization. And that really, disciplines the model a lot. You get arguably lower performances, but at a much more realistic leverage level. So we try to sort of benchmark the implied model leverage against, like, typical like leverage that you find in bond funds. In addition, I think you touched upon liquidity. Yeah, I think liquidity is a big concern. So the way how we modeled it in the model is essentially putting like a trading cost into it by basically looking at the portfolio turnover from one period to another, and that becomes essentially like we attach like a penalty. I don't recall the exact size, but we put some penalty that seemed to be appropriate for the trading cost in the corporate bond market. Obviously, that ignores maybe that some bonds are more liquid than others and so on. But, we had to model it in a somewhat reasonable but simplistic way. I think maybe you mentioned one third point.
Yeah, there's also the short selling.
Yeah, so short selling is indeed like a potential issue that we kind of sweep a little bit under the rug probably here in these estimations. So one would have to think exactly how you want to model that, or to what extent short selling constraints are binding for different instruments. Yeah, that's a good point.
I have a question for you both. Sorry if I intervene, because it's again that you're both here. I think both perspectives are actually valuable. Again, coming from a very different literature, doesn't have to do with modeling, but basically with what you model, and these are bond returns. So there is an interesting paper actually in the AR that looks at, can corporate bond returns being used to forecast macroeconomic developments? And they find that, yeah, they can be used, yeah. But what they also do is they disaggregate the returns. On the one hand, they create a fundamental return, so to speak, which is driven by the default risk of the firm. And then a second component that is orthogonal to that risk and is basically reflecting the dealer risk aversion, so to speak, right? And it appears to be, therefore, that in this bond market, it's not necessarily about sort of the individual corporate bond issue, but it's actually about the banks that are the market makers, right? So that appears to be important if I also want to predict what am I actually predicting. Am I predicting sort of like the fundamental risk of the firm, or am I trying to predict sort of the risk aversion of the intermediary there that's actually mediating here? So do you have a view on that? Is this sort of important? Is this something you could actually also differentiate and try to model specifically the corporate bond issue? So what's your view?
Maybe let me take that question first. First of all, we don't know what the dealer is in a specific bond, so we don't really know. It's not part of our feature set, and I'm not sure if he could get it as part of our feature set. Also, like in our case, in our paper, it really doesn't matter where the return is coming from, right? All what we matter is what is the best portfolio allocation that we can achieve to, get like favorable portfolio characteristics as a result completely out of sample.
Yeah, and maybe to add, I think actually you could say there's a third component in the corporate bond return, which is the treasury return. So the default risk, the treasury return, and then this supposed risk aversion of the dealers. And I think that this would mainly show up in shorter, like higher frequencies, maybe on the daily or intra-daily basis. And maybe on the monthly frequency where Oliver is focusing on, yeah, this effect would cancel out, I suppose. But I definitely think that, that like the dealers and their inventories have a lot of impact on the short-term movements in the corporate bond market. Yeah.
Perfect. Well, I think we're almost out of time, 2 minutes left. Before I thank you both, let me just briefly do a quick sort of, where do I have that? Hang on, give me 1 second. Here we are. So let's hang on. I'm there in a second. So here we go. So here we are. Almost. So here we are. So this is next month's webinar. I just wanted to point to. We don't have the topic revealed yet. So it's Tony Cookson from Colorado. He's going to be our presenter, and we're going also to release who is discussing this in the next couple of days. But we already want you to sort of like mark your calendars. April 8th, again, 5 to 6 p.m. Central European time. So we're looking very much forward to next month's webinar. But today, thank you so much, Oliver. Thank you so much, Robert, for sharing your insight. That was really interesting. I think there's lots of things to discuss, and we look forward to what you guys are doing next. Thank you very much also to you, to the participants, for the questions. Come back next month and look forward to next webinars in April. Thank you very much.
Yeah, thank you as well. Have a nice evening. Bye.
Thank you so much, Sasha. Thank you so much, Robert, for your comments.
Yeah, thank you as well.